Hello and welcome to the next in our series of Insights into IFRS 17. I'm Gail Tucker, PwC's Global Accounting Leader responsible for insurance. I'm a member of the ISB's recently formed Transition Resource Group on IFRS 17, and for many years I've been a member of IFAG's Insurance Accounting Working Group. I'm delighted to be joined by Anthony Coughlan today. Anthony is a director in our UK actuarial practice and one of our IFRS 17 experts.
Thanks, Gail. Very happy to be here.
So what we want to do in this video is really look at the differences between Solvency II and IFRS 17, conscious that insurance has spent a huge amount of money on Solvency II. And so the question is, can they leverage some of that investment in implementing IFRS 17? Now, I think the first thing to remember is the population of contracts under both reporting regimes will be different. So Solvency II applies to all contracts written by the regulated insurers, whereas for IFRS 17, it will just be contracts that meet the definition of insurance. So when I think of some life insurers, they will have what we call the investment contracts that have no insurance risk, and they will continue to be measured under the different model of IFRS 9 or 39 and IFRS 15. I think the other thing to remember as well is that IFRS 17 requires some components of insurance contracts to be separated out and measured separately. So it could be some embedded derivatives or some investment components. But if we then look at the population that is in both reporting regimes, I guess the question is, what are the similarities and differences between the two regimes?
In both IFRS 17 and Solvency II, there are very similar building blocks when you determine the base liability. You have your best estimate liability, which is a prospective, discounted assessment of the exposure and an allowance for risk. And many of the components within those two will be similar, be that the premiums or the claims and cash flows. That said, there's one fundamental difference, which is the contractual service margin. In IFRS 17, there is an additional liability which relates to how you're going to earn your profit over time. There is no equivalent concept to that in Solvency II, which is much more focused around balance sheet strength and meeting your solvency requirements. The contractual service margin will impact a number of different areas around the liability measurement, most notably around the level of granularity that you will need to do a lot of the calculations. That said, there will also be other differences between IFRS 17 and Solvency II. I'd like to pull out three of those at this point in time. Firstly, with regards to the cash flows. In both IFRS 17 and Solvency II, there is a lot of prescription about which cash flows you include in that best estimate liability. There are some notable differences though. For example, around the expense cash flows. In IFRS 17, only those cash flows which are directly attributable at the portfolio level are included in the liability assessment. Rather in Solvency II, a lot of those overhead expenses would be included. A consequence of that is that each period as those expenses are incurred, in IFRS 17, an insurer would incur a loss because there is no release of that associated liability. Secondly, turning to the risk adjustment. In Solvency II, as many people will be very familiar with, you have a very much regulatory prescribed transfer value view. So that will be you have to use a 6% cost of capital. It has to be that cost of capital methodology. You have to allow for certain levels of diversification benefit. In IFRS 17, it's much more principles based. Around assessing the uncertainty in the amount and timing of the cash flows arising from non-financial risk. By definition, that will lead to some calibration differences in terms of which risks you include. For example, general operational risks, which would be in Solvency II, will not be in IFRS 17. There are other differences as well. For example, in Solvency II, it is a net of reinsurance amount, while in IFRS 17 you'll need both the gross and reinsured balance. That said, from my perspective, I think one of the key things, if you were going to use the Solvency II risk margin IFRS 17, is really with regards to the level of granularity. In Solvency II, you determine an entity level risk margin. For IFRS 17, you're going to need to allocate that down, potentially with broad portfolios and annual cohorts. And the question is, can you take that entity level assessment and do that in a meaningful way, both at a point in time and to track going forward? I think the third and final area I'll just pick up would be with regard to participating contracts. In both Solvency II and IFRS 17, they're both broadly market consistent assessments of the options and guarantees. There will, though, be some differences around the discretionary cash flows. In IFRS 17, you're required to put both current and future policyholder liability cash flows into the balance sheet. Rather than Solvency II, it's much more restricted based on national law, what's known as surplus funds.
Thanks, Anne. One of the other questions I get asked about is discount rate. So we know in IFRS 17 we have the principle that the discount rate should reflect the characteristics of the liability, and that it can be calculated on a top-down or bottom-up basis. One of the questions I often get asked is, what about the IOPA prescribed rate in Solvency II? Can insurers use that for IFRS 17 purposes?
Very good question, Gail. I think a lot of the processes and systems have been set up for Solvency II purposes and can be used in IFRS 17. That said, there will be certain aspects of the Solvency II discount rate that cannot be used in IFRS 17. And we'll just go through some examples of those. Firstly, around the extrapolation approach for the basic risk-free rate. The way that's prescribed in Solvency II is it's a relatively early entry point to extrapolation, known as the last liquid point, and then you then hit what's known as the ultimate forward rate after a period of time. Both those two aspects don't directly relate to available market data, so those areas could be challenged when you're looking at it from an IFRS 17 perspective. Also in Solvency II, you have the additional elements of the volatility adjuster and the matching adjustment. The volatility adjustment doesn't really reflect the characteristics of the liability and therefore is unlikely to be permissible in IFRS 17. Turning then to the matching adjustment, that really impacts only a limited number of annuity type portfolios across Europe. For those portfolios where there is a close matching between the assets and the liabilities, there is an argument that the matching adjustment does reflect the characteristics of the liability and therefore could be permissible in IFRS 17. Having said that though, there are a number of technical areas that would need to be considered. In particular, the calibration of the credit allowance in that matching adjustment. So does that allow for both expected and unexpected default? How current is that credit allowance, or is it more of a passive long-term allowance? So there are things to consider. There is also more operational aspects around that. For matching adjustment portfolios, that discount rate is set at the fund level. In IFRS 17 though, you will need to have a discount rate for each annual cohort, so you need to think practically how you're going to do that. The other key difference to bear in mind, that's particularly with regards to the general model in IFRS 17, is that we need to store all those day one inception discount rates, which you won't have to do in Solvency II.
So discount rate sounds like a really interesting area we need to look at. I guess there's a couple of other areas of differences that we haven't touched on yet. So IFRS 17 allows the simplified optional premium allocation approach for certain short duration contracts. There isn't an equivalent to that in Solvency II, and that could be another source of difference. And we have more on that in a separate video that we've done on that topic. And I guess the other area is reinsurance. So I think Solvency II tends to look at things on a sort of net of reinsurance basis, whereas in IFRS 17, we measure the underlying insurance contract quite separately from the reinsurance asset held. And we'll have another video that will cover some of the consequences of that as well. So those could be two more sources of difference. So having looked at the sort of similarities and differences in terms of measurement, what about presentation and disclosure?
Another good question, Gail. In terms of presentation, when IFRS 17 you have an income statement, and importantly you have concepts of revenue. That doesn't really exist in Solvency II, which is very much more focused around balance sheet and solvency strength. So those will be key differences. Turning to the disclosures, well, it's perhaps not unexpected given the range of optionality that exists in IFRS 17. There will be quite a lot of mandated disclosures. A lot of those disclosures will be different to Solvency II. So they're not going to be exactly the same as you use in your quantitative reporting templates, your solvency financial condition report, or your regular supervisory report. Particularly around, the one I would focus on, really around the amounts reconciliations. So in IFRS 17, you have to disclose how your best estimate liability is moving over the period, how your risk adjustment, how your contractual service margin, how revenue, how loss components. A lot of quite detailed reconciliations which you won't have in Solvency II. That said, a lot of the things around the key risks and some of the key judgments will be very similar between IFRS and Solvency II, perhaps as you would expect.
Thanks, Anne. So that's some of all the similarities and differences from what the two regimes have. What does it all mean from an operational perspective? You started to touch on that with discount rates, but what are the other things people should be thinking about?
I think I'd highlight sort of 5 areas, Gail. Firstly, probably the obvious one is with regards to the contractual service margin. In Solvency II, as you said, there's no equivalent to that, so you're going to need to have a model to actually do that. There is a question about whether that exists in the actuarial risk function, or maybe that's more of a finance database. There's also then a question about whether you build it in-house or you look for some proprietary software to do that. second point I would come to is one that I think we've alluded to throughout this whole webcast, to be honest. It's around the level of granularity. And the fact in IFRS 17 you are going to have to track a lot of information, a lot of data at that annual cohort level. And that's something you don't really need to do in Solvency II. And therefore you're going to be looking at your actuarial systems, your accounting systems, those interfaces, and actually getting in a lot more detail. You're going to extract that data out. The third area I'd come to is the disclosures, the area we came to most recently. We've spoken about the range of different reconciliations that are going to be needed. That's going to require changes to charters of account, consolidation systems, and various other sort of mainframe type things that will need to be considered. I personally would recommend, if you're looking to start your implementation project, to actually start from then and work backwards. So the fourth area would then come to be around the timelines. And generally, IFRS reporting is much quicker than Solvency II. Therefore, if you were going to be looking to use a lot of your Solvency II systems and processes, you may need to speed them up, be that enhancing your models or maybe looking at more simplified approaches. I think the fifth and final area I'd come to is the Transitional CSM. Not something we've covered today, but at the point in time when the standard comes in, you'll need to work out what that contractual service margin is for the back book. That clearly will be a one-off exercise and likely to require quite a lot of data and systems and investigation work to actually put that into place.
Thank you, Anne. That's quite a lot to think about. So I hope you found this video useful. We've produced a publication using Solvency II to implement IFRS 17 that's available on our website that will give more information as well. I do hope you'll watch some more of our videos as we continue identifying the different aspects of IFRS 17. Thank you.